Good evening everyone. I'm from group 6. Today I want to explain about non-current liabilities. The first one I want to explain about 6.1. It is about the nature of non-current liabilities. Non-current liabilities is a business that due after more than 12 months or the company normal operating cycle which is longer. Ini bermaksud liability bukan semasa ialah obligasi perniagaan yang perlu dibayar selepas lebih daripada 12 bulan atau kitaran operasi biasa syarikat yang mana lebih lama. The second point is this non-current liability it's represent long-term financial commitments that cannot be settled within short term. Ia bermaksud ia mewakili komitmen kewangan jangka panjang yang tidak boleh diselesaikan dalam jangka yang pendek. The second one I want to explain about the purpose of non-current liabilities. The first one is usually taken to financial long-term investments such as property, machinery or expansion projects. Ia bermaksud biasanya diambil untuk membiayai pelaburan jangka panjang seperti hartanah, jentera atau projek pembesaran. The second point of purpose is allow business to spread repayment over several years, reducing short-term financial pressure. Ia bermaksud membenarkan perniagaan menyebarkan pembayaran balik selama beberapa tahun, mengurangkan tekanan kewangan jangka pendek. There are many examples under non-current liabilities. Okay, the first one is long-term loans from banks, bonds or debentures, lease obligation, that is long-term lease liabilities. The fourth one is pension obligations, and the fifth one is deferred tax liabilities. Next, I want to talk about the characteristic of non-current liabilities. The first one is long-term repayment, that is not payable within a year. Tu bayaran ini tidak perlu dibayar dalam tempoh setahun. The second one is may involve interest, that is like bank loans or bonds. Seperti pinjaman bank ataupun bond. The third point is contractual obligation. It means terms are often fixed by formal agreements. Ia adalah terma selalunya ditetapkan melalui perjanjian rasmi. The fourth point is affects liquidity and gearing. It means higher non-current liabilities can increase financial risk. Liability bukan semasa yang lebih tinggi boleh meningkatkan risiko kewangan. The next one I want to talk about the importance in financial reporting. The first one is reported in the statement of financial under non-current liability section. The second one is uses of financial statement look at terms to access. The first one is the long-term solvency of the company. The second one is the ability to meet obligations without affecting operations. The third one is the level of financial leverage. Next, I want to give some more information about the measurement and recognition under non-current liabilities. The first one is initially recorded at the present value of obligation. The second one is measured at the amortized cost or fair value depending on the accounting standard. The third one is any portion due within the next year is reclarified as current liability. That's all from me. Thank you.
Hi sir, my name is Divyashwari7. My metric number is F1125. Now I will discuss audit assertion and audit treatment for non-current liabilities. First is existent. The question is whether the liability really exists at the reporting date. For example, confirming a loan balance directly with the bank ensure that the company actually owes the amount shown. In accounting, we only recognize liability if there is a present obligation as required by IAS 37. Second is completeness. Auditor must check that no liability are left out. They review loan agreements, board minutes, or legal letter to identify any borrowings not recorded. Accounting treatment requires recording all obligations that exist before year end in line with IAS 1. Third one is valuation and allocation. This ensures the liability is recorded at the correct amount and properly split between current and non-current portion. Auditor may recalculate interest accruals or test amortizations schedules. The accounting rule is to measure liability initially at fair value and subsequently at amortized cost using the effective interest method under IFRS 9. Fourth one is right and obligation. Here the concern is whether the entity has the legal responsibility to settle the liability. Auditor inspects signed contract to confirm this. In according, only the actual obligor should recognize the liability as explained in IAS 37. Presentation and disclosure. Finally, liabilities must be properly classified and disclosed in financial statements. Auditor verify that borrowings are split between current and non-current, and disclosure includes terms, maturities, interest rates, and convenience. This follows the requirement of IAS 1 and IFRS 7. That's all from me. Thank you.
My name is Anusha Periyasamy. My matrix number is F1106. Today I'm going to explain about provide the discussion on the accounting system and control activities related to non-current liabilities. First, accounting system. First, recording and classification. Non-current liabilities, example long-term borrowings, bonds, lease liability and provisions, are recorded in the general ledger upon receipt of authorized contacts. Correct classification between current and non-current positions based on repayment terms. Explanation. All long-term obligation must be recorded immediately once there is an official contract or agreement. Proper classification is important. Non-current portion due after 12 months, current portion due within the next 12 months. Next, valuation and measurements. Initially recognized at fair value net of transaction costs. Subsequently measured at amortized cost using the effective interest rate method or as required by MFRS. Explanation. When first recognized, liabilities are measured at their fair value, amount received, obligation taken, minus any lease or transaction costs. Over time, they are measured at amortized cost, meaning the liability is adjusted for repayments, interest expenses and discount or premiums using the effective interest rate method. Third, authorized and documentation. All borrowings are approved by the board of directors or authorized committees. Loan agreements, repayment schedules and covenant terms are filed and maintained for audit purpose. Explanation. Strong internal control required that loans or bond issues cannot be taken without board approval. Proper documentation, loan contact, repayment plan, interest schedule, covenants must be safely stored. This ensures accountability, prevents unauthorized borrowing and provides a clear audit trail. Lastly, periodic review and updates. Regular updates to reflect interest accrual, repayments and reclassification of current portions.
Explanation: liability must be reviewed periodically, monthly or quarterly, to record interest expenses, update repayments made, and reclassify long-term liabilities into current liabilities when they fall due within the next year. Ensure financial statements always reflect the true outstanding obligation at reporting dates. Okay, thank you. That's all from me.
My name is Tashmita Chandran. My metric number is F1141. Now I'm going to present about control activities. Here is the 7 control activities. First one is segregation of duties. Separate responsibilities for loan approval, recording, and payment to avoid fraud or error. This means the dividing responsibilities so that no single person controls the whole loan process. This prevents fraud or mistakes because more than one person is involved, creating a system of checks and balance. Second control is authorization controls. Written approval required for all new loans, refinancing, or changes in loan terms. Every new loan, refinancing, or change in loan term must get proper written approval. Ensure that only authorized personnel can approve loans, reducing the risk of authorized or fraudulent transactions. The third one is reconciliation procedure. Monthly reconciliation of loans balance in the ledger to external statement or confirmation from ledgers. Loan balance in the company's record are checked monthly against bank statement or lender confirmation. Helps detect error, omissions, or fraud early. The fourth one is monitoring control. Review of loan covenant, compliance, interest calculations, and repayment schedule. Company is meeting loan conditions, calculating interest correctly, and paying installment on time. Keep the company compliant and avoid penalties from lenders. Access control. Restrict system access for creating or amending liability records plus secure storage or contracts. Also ensures contracts and loan documents are securely stored. Protects sensitive financial data from unauthorized use. Sixth is management oversight. Senior management reviews liability, balances, maturity analysis, and compliance with financial reporting standard. 7 is internal audit. Internal auditors periodically test loan transactions, interest calculation, and compliance with policies. Provides independent assurance that internal controls are working effectively.
Gayatri and my metric number is F1137. Today I will be presenting about on how to apply the audit procedures by evaluating the evidence provided or recommended to support the assertions and accounting treatments. Firstly, we should identify the financial statement assertion. Assertions tells us what management is implicitly claiming about the numbers. Common ones under ISA 315 or ISA 500. Assertion there are 6. Existence. Under the non-current liability, existence appears to be the non-current liability really exists at the balance sheet date. Completeness. All non-current liabilities that should be recorded. Rights and obligations. The entity is obligated to settle the non-current liability. Accuracy of valuation. The non-current liabilities are recorded at the correct amount. Cut off. Non-current liability are recorded in the correct accounting period. Lastly, classification and presentation. Non-current liabilities are properly classified as long-term and clearly disclosed in the financial statement. Next, we should link audit procedures to assertions. For each assertion, the auditor applies appropriate procedures to gather sufficient appropriate audit evidence. For example, suppose the account is non-current liabilities, the assertion existence. Next, the according audit procedure would be confirm loan balances directly with lenders or review loan agreements to verify they exist. Evidence type bank or lender confirmation letters, signed loan agreements. Completeness review board minutes, contracts and legal correspondence to identify unrecorded borrowings. Evidence type board minutes, legal correspondence, loan agreements. Rights and obligations inspect loan agreements to confirm the liability is in the entity's name and terms are binding. Evidence type original signed loan agreements, debt covenants. Valuation recalculate interest accruals and verify correct amortization of loan costs. Loan statements, amortization schedules, interest workings. Cutoff inspect loan drawdown and repayment documents near year end to ensure they are recorded in the correct period. Evidence type bank statements, payment advisors, loan drawdown notices. Presentation review financial statement disclosure to ensure proper classification as non-current and required note disclosures are made. Financial statement draft notes, accounting policy manuals. Next, I would like to explain further about the audit assertion and the following accounting treatment. Existence, the procedure would be confirms with lenders, inspect loan agreements. Evidence, bank confirmations, aid agreements. Evaluation, include liabilities only if they exist at reporting date. Accounting treatment, include liabilities only if they exist at reporting date. Completeness, review minutes, legal letters, bank minutes, legal correspondence, match confirmations to financial statement, check agreements valid. Recognize all known liabilities, rights and obligation, inspect loan agreements and covenants, signed agreements and covenants, measure aid closing period in correct period, measure at amortized cost interest expense, accuracy valuation, recalculate interest and amortized cost, closing balance agrees interest per terms, evaluation recorded in correct period. Accounting treatment, measure transactions in correct period. Classification and presentation, review repayment schedules, record transactions in correct period. Proper classification, adequate disclosures, proper classification, adequacy, disclosures per terms. Thank you. This is the presentation from our group. Thank you.